Hi, everyone. I'm Aristotle with RealWealth, and thanks for joining us on our Thursday educational webinars. And here with me today, you can see down there below is Richard Advani with Guarantee Rate. How you doing today, Richard?
Doing fantastic. Sun is out.
Yes, I know. We both, Richard and I, we live probably within 40, 50 miles of each other in Southern California, and we've had just torrential rain. It's been crazy. I think it said it's like the most rain we've received in a short amount of time in like 100 years. It's just we got so much rain out here, and I think there's more coming. So if you guys live in SoCal or even maybe NorCal is getting rain too, but we just got dumped on. It's been crazy, but the sun is out today, so we're enjoying some of the getting dried out here. So today we're going to be talking about giving everyone on the call here an update on the real estate lending industry and what's going on. We haven't had a lender on one of these webinars in probably about 6 months, so we're really due for an update, what's going on. And there's so many questions about what's going on in the lending industry. The mortgage rates are volatile. It seems like they're up one week, down the next week, up the next week. And so Richard is one of our preferred lenders that we work with here. You might have met him at our live event that we had in October. And he's great. He's been working with us for a very long time. We'll get into some of his background here in a minute. But thank you again for joining us today, Richard. I appreciate your time.
Absolutely. Happy to be here and share the latest update with everyone.
All right, so I'm not gonna read this word for word, this disclaimer, but basically it just says that, Real Wealth, we don't give you any kind of financial advice. We are strongly recommending you consult your accountant, tax advisor, attorneys, etc., based on your specific circumstance. We can't give you legal advice. And it does say that, of course, past performance is no guarantee of future results, and that everything has a risk to it. So, and you do have the possible loss of the amount that you have invested. So just seek out professional guidance. Professional legal guidance if you have questions on that stuff. So Richard, do you want me to give the audience background, and do you want to take it over and talk about your background and how
Yeah.
this picture relates to your lending process?
Yeah, absolutely. So I'll take it from here. Nice to meet everyone. For those of you I don't know, and thanks for the opportunity to share the latest update with everyone. So my name is Richard Advani. I'm based in Southern California. Been in the mortgage business for probably close to 19 years now. And early on in my mortgage career, I purchased my first out-of-state investment property. And I got to say, it was a rocky, rocky road, right? I went retail. I went solo. I was young. I didn't have, a team like RealWealth to help me. So it was a little rocky, but that's what really started my love for investment real estate. And, being 21 or so at that time, living in Southern California, me buying a house wasn't really in the cards. So at that point, I really started focusing my business on working with real estate investors. Fast forward to today, I've closed, north of $1 billion of real estate investment transactions, thousands and thousands of loans. And the cool thing is I actually met Real Wealth very early on in my career as well. So, probably in that 14, 15-year range, well before I had these grays I have now. So it's been cool to actually grow with them and learn from them, as I've helped their clients. We're licensed pretty much nationally across the country as well, which is awesome since obviously they cover so many markets. As you can imagine, in doing these thousands of transactions, I've had access to a lot of firsthand data, and I've been able to grow my own portfolio to north of 20 properties across the country, including some short-term rentals. And it's been amazing actually creating that portfolio. And I think the thing a lot of people run into, right, is the confidence to make that first investment and buy that first property, which was easy for me because I had access to all the data. I saw it worked. So, anyways, long story short, I am a real estate investor as well, which obviously pairs very well in working with other investors. I am a race car driver as well, as you can see from the picture. I race for Formula Drift. So we race across the country. If you don't know, drifting is where you're sliding your car sideways at crazy high speeds, and been a fun journey. And I also am an entrepreneur, as I'm sure a lot of you watching are as well. So I understand corporate structure very well, but also I understand importantly how important team building and the team you have is, right? In racing, as in with real estate, you need to make sure you have the right people in the corner. You're getting the right information that you can assimilate so you make the right decision and avoid mistakes. If you guys haven't already invested with Real Wealth, obviously, it's awesome to have a resource like that. Like I said early on in my career, my first couple investments I didn't, and I learned some valuable lessons. Let's say that at least. So guaranteed rate, the company I work for. I'm sure you guys have heard of us. We're the second largest lender in the country out of all the banks and mortgage lenders, brokers, whatever it may be. We are the big player in the market. We are a full service direct lender, so we loan our own money, which means we can close very quickly, of course. We offer conventional loans and non-traditional loans, and we'll kind of get into some of those non-traditional loans later. Conventional loans typically are going to have the lowest interest rates for you. We offer foreign national loans. We offer jumbo loans for you guys purchasing primary homes as well. And then once again, we'll touch on those over 10 financed, more creative low doc loans known as the DSCR loans. A major topic today, of course, is the impact of using leverage with real estate. And Aristotle, if you can hit that next slide, please. Sorry, I didn't go in order. So obviously, what to expect with rates in 2024, right? So the first thing I want everyone to understand is how the bond market actually affects interest rates. Mortgage rates, fixed mortgage rates, are not tied to the Fed rate. And what's interesting about that is mortgage rates have already come down dramatically from where they were, at the third quarter and leading into fourth quarter last year. I'm sure all of us at home heard, for primary home buyers, let alone us investors, rates were, 8% for a brief period and in the high sevens for quite a while. So the first thing I want you guys to know, and I don't think the media is giving us enough attention to this, but rates have already moved down sharply, right? As investors, we can get loans in the mid to high sixes now on a 30-year fixed, which is, once again, 1.5+%. And I say that because a lot of the investors I talk to, or at least the reason they're giving themselves for sorry about that. And the reason they're giving themselves for that analysis paralysis is interest rates. And, a lot of them are surprised to hear that those rates have come down. Now, to elaborate a little on kind of the bond market. So the 10-year Treasury bond, and if you guys have an iPhone at home and you can put in your stock section, type in TNX, it'll pull up the graph of that 10-year Treasury bond. And generally, fixed mortgage rates move in conjunction with that, right? So if you see the Treasury bond move up, generally fixed mortgage rates have moved up with that, and vice versa if it moves down. And what you'll note is, we hit actually about a 12 to 16, 18-month low 3 weeks ago on interest rates, right? They dropped really low. The Treasury bond hit, I think, 3.8. And this week, they've been on quite an upward rally. And, a lot of my clients are kind of trying to understand why. And, basically our Fed chairman spoke on Sunday, and as we all know, said the economy is doing extremely well. Rates are going to stay higher for longer. We're going to look at 3 cuts versus 5 cuts. But more importantly, with the economy doing well and unemployment low, a lot of people pull their money out of the bond market, which typically people will put money in for security and dumped it back into stocks. And in turn, the bond yields were affected and, rates have come up as well. So what does that mean for us, I guess, moving forward, right? Once again, you can get a rate today in the, mid to high sixes, which is still very, very low. So what does that mean for us once again is as we move forward through the second and third quarter and moving into the fourth, a couple things are going to happen. Firstly, the Fed themselves are going to lower their rates. And the Fed rate is tied to your credit cards, your home equity lines, your auto loans, right? So not directly tied to mortgages. But generally, as you see this, the Fed rate move down, the Treasury bonds will react as well. And our general understanding is that, come summer and moving towards the end of the year, we are going to see further reduction on rates, albeit a little slower than what we've seen in the last 45 to 60 days. Keep in mind, we were at 8% range and now we're in the high sixes. So, I'm hopeful we can get to the low sixes for investors and maybe round out the end of the year in the high fives. But if you kind of hear where we are now versus what's projected, there isn't going to be this massive drop from where we are, right? That drop has already happened. And if you're waiting for rates to move 0.5% lower from where they've already moved down, let's say by summer or so, well, guess what? That's what everyone is waiting for. And there's going to be a ton of competition come summer as the rates continue to move down and as we enter home buying season. So, as we always say, you're married to the property, but you're dating the rate. Rates are already pretty attractive historically. If they come down further, you can refi in the future, right? Don't buy retail. Don't get caught in the masses trying to go and buy properties. Once everyone else has woken up, it's normally too late, obviously, to get the opportunities that are available now. So one of the important topics today, of course, is the impact of using leverage. And does it make sense to buy a property with minimal cash flow? First thing I want to kind of cover is kind of a comparison here between the stock market and real estate, right? A lot of us wonder, hey, what makes more sense to invest in and what has delivered a higher return historically? And if you see in this example here, if we compare the S&P 500 in 2003 versus in 2023, there's about a 400% gain in the S&P 500, right? Which is huge to have that much of a gain in merely 20 years. And the national average, for home gain on real estate during the same time period was roughly 220%. So right away you'd say, hey, Richard, well, stocks look like they're a much better investment, right? Well, yes, if you were paying cash for real estate, stocks potentially could have been a better investment, although with some volatility over the last 20 years. However, once you factor in that most of us are buying these assets with 20 to 25% down, and you factor in that you can participate in the growth of that investment, 100% of it, right, with just that 25% investment, the real estate returns, factoring that in, was actually 500%. Far greater than that of the stock market as well. So, the first thing, it's very important to understand how important leverage is and how beautiful leverage makes real estate of an investment, right? There's tons of other tax benefits and stuff that we'll get into, but merely on the fact that you can participate in the growth of the investment with a relatively minimal down payment is huge, right? And I know a lot of us that have owned real estate for quite a while have experienced that. So, what does that basically mean for us today? And I think what it comes down to for us, a lot of us that may have been on the fence in terms of investing in this market is, cash flows are a little more limited than, of course, what we've been used to, right? So it really begs the question, does it make sense still to invest in real estate with a, minor to moderate amount of cash flow versus what, we've been spoiled with? And next slide, please. Thank you, sir.
Yeah, I wanted to add something to this.
Yeah.
The other thing to consider, your analogy here, the stock market, is I don't know many people that keep money in the stock market for 20 years. The challenge is a lot of people out there in general, they're looking for the quick returns, the quick thing. And so they buy and sell, and they can open their phone up and buy and sell stocks like it's, nothing. But the nice thing about real estate investing is that it actually keeps you locked in. It forces you to hang on to the asset. Whereas, you can't just click a mouse and sell your house in a day. It doesn't work like that. With stocks, people get antsy when the market goes crazy, or when the market starts softening, they start selling or buying like crazy. And it's just like, I don't like to live like that. I don't like to check my investments every day and be on my edge of my chair, always saying, okay, should I sell? Should I buy? My real estate is just performing, every month and every year, so it's just to me, it's a lot less stressful to have to worry about that.
Well, it's that forced discipline, like you said. And, look, at the end of the day, a lot of us did very well in the stock market, right? In the last 20 years, it was hard not to. Everything was going up, right? I had 100% return years and an 80% return years, and we all did. But in a market that's not generally appreciating, we have to be real with ourselves, right? We can say, oh, we've invested in this and we're day traders. But if you look at how much you're actually making with the volatility and, as you very well mentioned, or so, with the human emotion aspect of it, we're probably buying and selling at the wrong times too, and like you said, the force of discipline is a huge benefit in itself.
Have you ever heard that joke, Richard? How do you make $1 million in the stock market?
I don't think I have.
You start with 2 million.
There you go. There you go. Well, that's a good segue to our next kind of session here, which is, whether it makes sense to buy a property with minimal cash flow. Now, I want you guys to look at this example here on the screen, and we're talking about $300,000 purchase, 25% down, interest rate at 7%, and rates are lower than that, but I'm putting 7% just because that's a number in a lot of people's mind of whether they'll invest or not. So I want this to be a high scenario, right? A conservative scenario. 30-year fixed, and you'll notice under cash flow, I have a question mark. So although cash flow is very important, and we all recommend you buy a property that's at least covering its basis or generating some cash flow, I'm leaving that out of this example because it's not the point I'm trying to make here. The other thing is, one of the assumptions I made in this next slide is a 3% appreciation rate. Now, probably a lot more conservative than it should be, and a lot more conservative than what you may see on some of these pro formas out there. And it is, right? One statistic to know is that from 1968 to 2009, the national average appreciation rate was 5.4%, almost double of what I'm using here. And the reason I stopped at 2009 is because of the skeptics out there, right? I want to appease you as well. Let's just say the last 15 years of crazy real estate appreciation was an anomaly, which it's not based on statistics, but let's say it was. So based on 68 to 2009 is where I'm stopping. It was 5.4% annual appreciation. So I think we can all agree here, as conservative as you are, that 3% is a very safe assumption on the example I'm about to do. Probably under, but once again, I want to show you guys really the power and the long-term wealth building effect of real estate. And I mentioned long-term is most of you that, once again, that have owned real estate long-term have experienced that, right? Year 5, year 10, that's where we really start seeing our return. And now, with this example on the screen, and follow along with me. So once again, we're modeling that $300,000 property, 75,000 down, 25%. And you'll note I've broken out a 5-year kind of breakdown here, and I've looked at two main things. I've looked at your equity gain based on the modest 3% appreciation. I know I can't hear you guys, but I'm sure most everyone out there agrees that's a very conservative number. And also the return on amortization, right? The principal pay down that you're experiencing every year, which gradually increases, right, on a 30-year fixed. And we'll kind of run through this here briefly, but if you see, year 1, right, there's no equity, and we're kind of just setting that aside, right? Because it's going to take year 1 to get that. Your principal pay down on year 1 is $2,285. And what I mean is, when you make your mortgage payment, obviously a portion goes to principal and a portion goes to interest, right? That $2,285 is 3% of your $75,000 down payment, right? And there'll be closing costs in there as well. So these are rough numbers, just so you guys get an idea, once again, of that wealth building effect. So moving on to year 2, 3% equity gain, you gain $9,000 in equity. The property value is now $309, and your principal pay down has now, at the end of that year, increased to $4736 cumulatively, right? So that $4736, right away, you're looking at a 6% return on amortization, okay? And it looks like I actually lost a block here somehow, but I'll go over it with you. That block I lost was showing the percentage equity gain, right? So if we look at year 3, $18,000 is your equity gain cumulatively at 3% a year. Now, $18,000 is close to 20% of your $75,000 down payment. So basically, at the end of year 5, and most of us are buying real estate, I think, for 7, 10 years, if not longer. But at the end of year 5, based on your 3% equity gain per year, that conservative number that we agreed upon, you would have gained $37,652 in appreciation, right? Which, if you look at your down payment, that's over 50% of your down payment. You gained, on the back end, wealth building in appreciation. Now, if you look further down, by that point, you would have also paid down $13,203 of principal, which adds up to 18% of your down payment of 75,000, right? And I don't know why I lost that column, but basically you would see a 50% under the 37,652, right? You gain 50% of your down payment back by year 5, and you've gained another 20%, 18% in principal paydown. So you're at 70% of your initial investment of wealth building at year 5. And keep in mind, mind you, we've not talked about cash flow, right? Cash flow is very great to evaluate investment to investment. I'm not disagreeing there, but I want to invest based on such strong fundamentals that the cash flow for me is almost the bonus, right? What if I have a vacancy that'll eat the cash flow for a year? Is what I hear a lot too, which is true, right? The good news is with these turnkey and new construction properties, most of the time they're so fresh and nice that people want to stay in them longer, right? If you're first person taking a shower in a new construction home and you're a tenant, you probably want to stay there a little while. So this is really interesting because you hit the 10-year mark, as you can imagine, and you've more than made your investment back just on the wealth building aspect. And let's say we threw $200 a month in cash flow at this deal, right? So 2,400, an extra 3% cash on cash return on the front end. Well, ask yourself, what is that $200 a month going to do for you in terms of your quality of life, in terms of making you wealthy? Not a lot, right? And I say that because it's important for us to take a step back and remember why we're investing in real estate. It's not get rich quick. It's building wealth over the long term. And, with this example, I'm sure a lot of you guys can actually see conservatively how much wealth this builds just in 5 years, not even talking about cash flow. If you get at the end of 5 years, if you made your, $200 a month cash flow, that's great. Now, one thing this hasn't taken into account is, because we're not talking about cash flow, but is the rent growth. And I know Airstyle probably wants to chime in. The last thing I'll say is, properties I bought at a 5% cash on cash return 8 years ago that were generating, they rented up $13.95. I was making $150 a month. Well, now the rent's gone up to $18.95, right? 8 years later. So my cash flow went from 150 to now 650. So the rents didn't have to triple for my ROI to triple, right? They just needed to go up versus the amount of cash flow I was already getting, which was 150. Well, rents went up 500. Now my ROI on that property is, crazy percentage wise, cash flow, and it's appreciated and everything else. So I'll kind of let you chime in here too, Aristotle. But this is a very, very powerful example, and it's a very conservative example of a 5-year lookout. And there's no variables here, right? Besides depreciation, conservative, modest, but we're not talking about rent and vacancies and any of that, right? That's on the front end. So, Aristotle, yeah, I'd love to hear your thoughts.
Yeah, no, this is a really good education to point out. And you and I talked about this before talking today. We had a conversation about this, and yeah, it's true that $100 or $200 a month is not going to change your life right now. Cash flow is always good, and the majority of properties that our members are buying through our property teams and builders and sellers, they are cash flowing. Some are cash flowing more than others. But your point is well taken here, that leverage is amazing. And I when I'm talking to clients on the phone, I try to have them visualize, 5 years out, 10 years out, because that's really where you need to look at. If you're employed and you're making your income and you're working, you don't plan on retiring anytime soon, cash flow is not necessarily important. It's great to have that for reserves and maintenance and things like that, but look at the big picture. And in fact, if people are interested, we use that program called Deal Check, which allows people to analyze properties. But the really powerful thing about the software is that it allows you to look at, I think it goes up to 30 years. Now, it doesn't show like principal pay down and things like that, I don't believe, but it does show you, you can factor in rent increases and all the different things, and it shows you the bigger picture. And that's really what you need to look at. Because like you said, this is not a get rich quick thing. This is really about wealth building. And I know a lot of other property teams talk about this all the time. And it's really, I'm glad that you brought this demonstration up. So thanks.
Yeah, definitely. And even staying on it just for 1 second is, if you had the opportunity for you watching to buy a good quality asset in a good area, new construction or renovated, right? If you had the opportunity to buy it today and it made you $50 a month, right? It was slightly over break even, but looking at this, you see the wealth building effect. What are you waiting for? Now, the great news is most of the markets they offer have varying levels of cash flow, some good front end cash flows, right? There's a lot of seller incentives going around. So the point of this isn't to say, hey, there's no cash flow and completely forget about cash flow. Cash flow is important, but it's not why we're really investing in real estate. And once you realize that and you look at this example, you realize there's nothing to wait for here, right? The opportunities are here now, and the opportunities will continue to be here. But basically, I guess what I'll recap on this slide is, you know, if you today rates are in the mid to high sixes. Let's say you were waiting for them to get to the fives, right? What's going to change? You're going to make maybe 1% more cash on the front end, probably maybe 1.5%. Still not a material difference as we just determined, right? It's not going to change your life. What doesn't change, whether it's 6.5 or 7 or 5.5, is this example we have up here on the screen and the amount of wealth you build by investing in real estate, right? We haven't even talked about tax benefits, nothing, right? I'm getting all that noise out of the way with just this very clean, specific, easy to understand and conservative example. So I
Yeah,
guess I'll stop there on
perfect.
that one.
Yeah, that's okay. Yeah, so let's talk about. I appreciate this again. This is a really good point to bring across. Let's talk about some of your loan programs and how they can benefit investors.
Absolutely. I know we're probably running low on time, so I'll move pretty quickly here. But yeah, as we touched on a little earlier, we offer pretty much everything under the sun except for commercial loans for properties 5 units and over. But we offer a conventional 30-year fixed. You can actually go as low as 15% down for single family investment homes, although you do pay PMI and obviously the rates are impacted. Generally, well, the conventional 30-year fixed still is the best lowest rate, lowest cost option for all of us out there. There'd be no reason to take any loan but a conventional unless either you're over 10 properties or you maybe don't qualify because of income and creative accountant or whatever it may be, or maybe you're retired or you don't work at all, in which case the DSCR loans are a great loan option that we have to offer people. DSCR stands for debt service coverage ratio, and I have a little slide on it where we'll cover after this one and go into some specifics of how it works, but there's no limit on the amount of finance properties you have. There's no income required either, so that's awesome. We do offer HELOCs and HELoans as well. Equity lines are in the 9 to 10% range right now because they are tied to the Fed rate, which obviously is at a 20-year high and has not come down yet. But those are still very good options for accessing short-term capital, maybe to buy a property in cash and refi it later or whatever it may be. And then we do have some cool specialty programs as well. If you're selling a program, if you're selling a property, we have a program called Lock and List It that allows you as the seller to lock a rate for a prospective buyer buy down that rate, incentivize that rate, and market the property with that, right? Hey, the seller is going to get you a 5.5% 30-year fixed. And you can do that because you actually lock and secure that rate. So if you are selling a home, primary home or rental, talk to me about that program. It really helps make you stand out versus other listings. And then the forward commitment program. A lot of you probably already have heard about this through obviously RealWealth. A lot of the builders and markets are offering really low interest rates in the 4% range for a 30-year fixed on the properties they sell. So if you've been sleeping on that, call Aristotle, talk to one of your RealWealth counselors, because you pair that with the wealth building example I said earlier. I mean, if you're going to get a 30-year fixed in the 4% range for an investor today, there's really no reason to wait. All right, and next slide here when you're
Yeah.
ready.
Hey, real quickly, what is a HE loan?
A HELoan is just a fixed second. So instead of getting a line for 300,000 that you can draw and repay with a HELoan, you take the whole 300,000 lump sum up front and you immediately move into the repayment period.
Interesting. But can you get that on a rental property?
Yes, absolutely. The terms are not extremely attractive. Mind you, for a primary home, they're near double-digit percent. Where most people utilize them, though, is on our primary homes, right? We don't want to put debt on them, but a lot of us have a lot of equity. So if you can set up a $300,000 HELOC, for example, set it as an emergency fund or use it to close on some real estate very quickly and then refi to pay it off. That's kind of how they're used in this market, given the rates are high.
Okay. I know we get a lot of questions about HELOCs on rental properties, but you're not doing those, right? Do you know any, or are you doing those?
We do, yeah. Generally, you're looking at 70 to 75% loan to value. So you would have to have a sizable amount of equity in the rental, but we do offer them.
Oh, that's good to know because a lot of people ask all the time, and I usually scratch my head and say, you know what? I don't know any banks that can do HELOCs on rental properties because I know there's a few lenders that will do them if the property's free and clear, but if you're saying that you have to have, you said 30% loan to value? I'm sorry, 70%
Correct,
loan to value. Yeah, so
correct.
so that's not too bad. So if someone has had a property for 10 or 15 years, they could probably most likely get something like that. And what are the rates on
Exactly.
HELOCs these days? Like 8%?
No, no, more for primary homes, they're near 10%. For investors, they're 12%. They're very high.
Yeah. Yeah, gotcha. Okay.
Yeah. All right, so touching on the DSCR loan, DSCR stands for debt service coverage ratio. Yeah, I've said that a lot of times. That's why I can get it out so well. But basically, it's kind of like a commercial loan. It allows you, the way you qualify is by the income the property generates itself. So, in order to qualify for a DSCR loan, the main thing that we're interested in is that 100% of the gross rent covers the mortgage payment, including taxes and insurance. As long as it does, it meets one-to-one DSCR and you're eligible for the loan. We do still pull credit because your credit score does determine your interest rate, and we do need to verify the funds for the down payment. The beautiful thing, though, is there's no limit on the number of finance properties you have. So, if you've exhausted your conventional 10 loans, there is still life after 10 loans with this product, and it is a 30-year fixed as well. Now, you are going to pay a premium over and above conventional rates, typically, about 1% higher than conventional rates, but it does offer that 30-year fixed, and it's a great product, once again, if you've been turned down for a conventional loan, or if you're not working, retired, whatever it may be. If financing has been an issue with you entering the real estate investment market, that's no longer an issue with this product. Now, you do have to own a primary home. That's one thing to note. But if you own a primary home and you've been trying to invest in real estate, this product is the solution for you, and it's very easy to qualify for.
Yeah, this is I remember a few months ago I referred someone to you and they hear the term, oh, I think I want to get a DSCR loan. And I said, well, how come? And they said, well, because my debt to income ratio is too high or this and that. And so I got them over to you and they're like, no, we can get them a conventional loan, if you pay it on this credit card or whatever. So that's the great thing about working with you is that not only you're not just doing the loan application, you're actually going to strategize with that person and say, hey, no, look, if you pay off this $3,000 credit card, you're gonna qualify for a conventional loan. It makes way more sense to do that than pay all the points and the fees for the DSCR loan.
Exactly, and I'm kind of a nerd about those things. When someone is referred over to me and they say, yeah, I can't get a conventional loan, or I've been declined by 5 other lenders, that excites me because that's a challenge for me. And I don't have a magic wand, but I would say a solid 70, 80% of the time I'm able to qualify that person, whereas they may not otherwise have qualified. And a lot of it is my understanding of taxes and corporate structure and, write-offs and things we can add back. But anyways, if you did come over to me for a DSCR loan, I still make sure I do my job and vet that you won't qualify for conventional. Not because I make more money doing conventional loans, or anything like that. It's because I want to make sure you're getting the best possible financing that you qualify for. And like I said, I love the challenge of someone who's been declined elsewhere, maybe because their situation's too complex. Excuse me. Okay, so the way we'll kind of round this out is with this major, major change that happened probably about 45 to 60 days ago now. It hasn't gotten, no, sorry, it happened January. Yeah, so it hasn't got enough attention yet, in my opinion. So as long as I've been doing this, to buy an investment duplex or fourplex, more specifically, as a primary, excuse me, an investment as a primary home, to buy a duplex or a fourplex, you needed to put 25% down. And as you can imagine, most first-time home buyers trying to buy a home, and trying to buy a fourplex, generally they're not going to have 25% down, right? So historically, 2 to 4 unit properties have been traded between investors, right? And they haven't quite appreciated quite as much as single families either, just because there's way less demand given that the average home buyer isn't trying to buy a 2 to 4 unit, right? They're trying to buy a single family home to live in, paired with the fact that you needed to put 25% down to buy this 4 unit property. As of January of last year, or of this year, excuse me, Fannie Mae changed the rules to now allow you to purchase a primary 4 unit property. So you live in one, rent the other for just 5% down. And what's crazy is, the conforming loan limits that used to be 417,000, if a lot of us remember back in the day, for a 4 unit, they go up to, depending on your market, over $2 million, right? So you can buy a $1 to $2 million fourplex with 5% down. It's wild, right? You can buy an asset that big and that expensive with such a low down payment. Now, that begs the question, right, for a lot of us and a lot of you listening is, well, I already own my primary home. I can't go and buy a 4 unit now as a primary home. Firstly, I'm not going to do that. Secondly, no one's going to believe that I'm going to move from this house to this 4 unit, right? So, begs the question, why do I bring it up? Well, for a couple of reasons. One is, if you are listening to this call and you have been locked out of buying a home in the market you live in, and it's sad, but in California, you make 200 grand a year, you still can't buy a house, right? So I'm assuming you either been sitting on the sidelines, or if you're smart, you've been buying investment real estate with RealWealth. But whether you fall into either of those buckets, there is an opportunity now for you to get in and participate in the housing market and also buy a high quality investment asset, right? And what I mean by that is, one of the beautiful things about buying a multi-unit property as a primary home buyer is you can use the rental income from those other 3 units to add to your income, now making you qualify for a lot higher purchase price, right? And just throwing a random number out there, but maybe you only qualified for a $600,000 single family home. You're like, I'm priced out of the market. Well, using rental income from 3 units on a fourplex now may allow you to qualify to buy something for $1 million because you have that additional room in your debt to income. In the property for a year. After a year, rent out your other unit, right? Go rent a house or buy a small house, buy the next, property that you're going to live in for a little while and then maybe turn into an investment property. If you have children out there that are in their 20s, 30s, whatever it may be, and they don't own a primary home yet, this would be a great thing to bring up to them. And with that low down, it's something that's feasible for you to even potentially help them with the down payment, right? It'd be awesome if you had a 25-year-old who makes 150 or 30-year-old who makes 150,000 a year. Now they're able to buy a $1.5 million property with, your gift of the 5% down and the ability to use those other, the income from those other units. So it's a major, major change. The last thing is it's a benefit for us as investors overall as well, right? Remember, one thing I mentioned earlier was appreciation historically is not quite as high on multi-units because the buying pool is way smaller. It's only investors buying them. Well, at 5% down, you're going to have a lot more of a buying pool opened up to buy these 2 to 4 units, which means demand's going to increase for them and values in turn, I think, will do well overall. So yeah, if you don't own a home yet, take advantage of this. If you have children, friends, family who don't own a home yet because they're priced out, definitely call us on this program. It's incredible.
Hey, Richard, so what's the difference between this and an FHA 3.5% down? Because can't you do this on a 3.5% down on a duplex or something? Is it, or no?
You can with an FHA loan. FHA loans have kind of evolved in the last 8 or 9 years to a product that's geared towards people with not so good credit. For the longest time, while conventional lenders after the crash required 20% down and 25% down, it was great because FHA still had 3.5% down, right? What's happened in the last 8 or 10 years is conventional loans now offer 3% down on a single family, right? So even lower than what a FHA is on a single family. So that begs the question, well, why does FHA exist? Well, conventional, you still need to have pretty good credit. The low down payment preferred option, if you have good credit in this market, is conventional. The problem with FHA loans is they're very expensive, right? They have upfront mortgage insurance, so a fee basically that you pay. They have monthly mortgage insurance, which is now permanent, right? You
So
can't
this
remove it unless
5% down does not require mortgage insurance.
The mortgage insurance is built into the rate, or you can pay it monthly, but it's a lot cheaper than what the FHA mortgage
Mm,
insurance is by a long shot.
gotcha.
So yeah, it's a huge,
Okay.
huge program.
Okay, gotcha. Yeah, this is cool. Yeah, I mean, look, if I was young and I was living at my parents' house and I was ready to move out, I would use this to buy a duplex, and that's a great way to start your investing career if you can do that, and then eventually move out, rent out of the unit out, buy a primary down the road, and you get yourself a duplex for 5% down or whatever. It's pretty awesome.
Yeah, or
So
partner with a buddy that's in the same predicament as you, right? Stable income, stable job, can't afford to buy. Well, guess what? You buy a duplex, you each live in a unit. Now you're participating in the housing market.
yeah, yeah, yeah. So okay, so how do people get a hold of you here?
Absolutely. So up on the screen, you'll see my website, my email address, and my phone number. I get a high volume of calls. So if you directly call, there's a chance I may not answer. The best way is drop me an email. We'll schedule a time to connect. I'm happy to answer any questions you guys have. As Aristotle mentioned earlier, I'm not just the rate and fees lender. I provide a lot of insight to my clients based on the amount of deals I've done, obviously my personal real estate expertise, but also really strategizing on your short and long-term goals and the best way to get there with financing. If you're not ready to buy something yet, you can still call me. I'm not going to try to pull your credit. I'm not going to try to get an app. We can just have a conversation, and I'm happy to share whatever information you need. So that way, when you are prepared to make your purchase, whether it's in 2 months or 2 years, you're well armed for that. So don't be afraid to reach out if it's just investigatory at this point as well.
Yeah, perfect. And we have Richard's information on our website. So if you frequent our website a lot, you go on there, once you log in under the resources page where we have all the resources and vendors we work with, Richard's under the conventional and non-conventional sections because he offers that DSCR loans and other loans as well. So, okay, so we are going to open up for some questions here before we wrap up. So we've got about maybe 10 or 15 minutes to answer some questions. Let me first go to the next. Actually, I think I'll leave your information up here actually while we're doing this. This will be better so
Thank
people
you.
can jot it down. So Michelle's asking, do you sell your loans?
So that's a good question. We are the second largest lender in the country. We don't sell our loans. I think what she's referring to is servicing, right? Who you send your payments to, and who are on your mortgage statements. As the largest lender, we definitely sell or transfer servicing of, a good portion of our loans, which enables us to stay in the business of efficiently writing mortgages. We're not a broker though, right? We're not loaning someone else's money. We close with our own money, but generally there's a chance within 3 to 6 months that your loan will be placed with a servicer who you'll send your payments to for the remainder of the loan. Keep in mind, whoever you get a loan from, whether it's guaranteed rate or Wells Fargo, B of A, or whoever, it's Fannie Mae actually. Everyone sells the loan to Fannie Mae on the back end. In fact, generally you'll get a letter letting you know that, hey, Fannie Mae is the real owner on your loan now, but don't confuse that with servicing, right? But to answer a question, yes, generally we will transfer servicing of our loans. They don't bounce around a lot, so typically you'll end up home at that first transfer of servicing.
Perfect. Okay. Question here from, see if I can pronounce your name correctly, Lilas. And he or she is asking, besides checking with rates, what websites can we get rate changes for? And I hear this often, but there is not really, I mean, isn't there like bank rate, but isn't there like, there's not really a website that gives you like up to the minute rates, right? They need
There
to,
isn't. Generally, what I'll have my clients do is, I'll give them a rate quote on our consultation call, and I'll have them make note of where the 10-year treasury is. That way they can kind of gauge not the exact rate day to day, but what's happened since they had that quote, right? So if I quoted you today at 6.5% rate at 2 points and the treasury's at 4.1, well, if in the next couple of days treasury's at 4.3, odds are your rates moved up, slightly, and vice versa if it's gone down. To get specifics, so generally you need to reach out to me and drop me an email and say, hey, I noticed the treasury bond moved down, which I'd be like, high five, you're watching that. But hey, what does the rate look like now that it's moved down? And I'm happy to quickly send that information to you without an application and without a credit check.
okay. Yeah, because rates, people need to understand that there's so many factors that are considered when you're looking at rates, I mean, your credit score, your DTI, how much you're going to loan. I mean, there's a lot of things they have to take in consideration. So if someone says, what kind of rate can I get today? You're going to probably answer, well, I don't know your credit scenario. I mean, I can kind of guesstimate, but I can't give you an exact rate because we don't have everything from you yet. So that's why there's no website that has it out there, because there's just, it's a multi-pronged approach. Okay, let's see here. How about Taye is asking, what about the fact that houses cost more these days, not as much room to appreciate? She was probably, he or she was talking about your presentation about the leverage analogy and asking not as much room to appreciate, right? Well, I can answer that real quickly, but I guess it depends on where you're buying. I mean, real estate historically has always appreciated, right? Yes, there's up and down cycles every decade or so. But you know, some people ask this question too, Richard. They say, well, Jacksonville, Florida, you know, houses are 400,000. How much more room can there be to go? Well, I mean, I don't know. I mean, look at California and over the last 30 years. You know, you could buy a house 30 years ago in California for 150,000. Now it's worth over $1 million. I mean, it's still going up, right?
Well,
So
and to answer a question, I mean, if you look at the example I used a 3% appreciation right now. Once again, the national average from the 60s to the early 2000s was 5.6%. I've not included in that 5.6% average the last 15 years, right? Where the average would be closer to 10%. So I've gone super conservative. 3% appreciation is half of the national average for the last 50 years. So I would say it's safe to see that. I think the thing that's powerful about that is most people, if I would have taken the dollar away and this example away to see how much benefit there is, and I told them 3% appreciation, they would take that at face value. But this is crazy because you see just based on that 3% how much wealth it builds, right? It makes it hard almost to fathom that. Okay, wait, you're saying with no cash flow, with modest appreciation, 5 years in, I'm going to have this big of a return, right? On that example we gave. It's kind of hard for them to fathom, but that's a super conservative number, right? And that's not market specific. I'm talking nationally. You know, the return was 5.4% from 1968 to 2009. So cutting out the last 15 years of craziness that has happened, we were at 5.4%. So the example is 3%. So keep that in mind.
right.
You know, and it sounds like she's conservative, like I am too, which is why I went that conservative. Those numbers
Yeah.
should be attainable 100%.
Yeah, yeah. But just to hit on that again, I mean, if you know anyone who's owned rental properties or even a primary home for, let's say, 30 years, I mean, the house has gone up. So again, who was I talking to? I was talking to somebody, I don't know, about a week ago, and here in California, and they said, yeah, I bought this house back for $60,000 back in like 1972, whatever, right? And now it's worth like, you know, 1.2. So I mean, I keep saying California, but it could be anywhere. But homes will go up in value, and I think people get a little bit skittish because they get that, you know, 2008, 2009 mortgage meltdown feeling like, oh, prices are over, you know, they're overinflated, there's a crash coming. And Kathy Fecky has done numerous webinars with different economists about this, and they all say that there's no crash coming because there's nothing to force a crash. But prices in general will keep continuing to go up, and the income will also go up. And I mean, heck, look at minimum wage; it's like $30 an hour here in
Well,
California.
there's strong fundamentals though. That's why there's no crash coming, right? It's
Right, right,
solid,
good
it's
point.
strong, healthy. There's low actually supply. There's a heavy demand. People that are in homes should be in the homes, right? They've been underwritten the right way. All those mistakes that happened before aren't there. And also, there's like national household equities, like 50% loan to value average or 60%,
Yeah,
right? People have hundreds of billions of dollars in equity. They're not going to go into foreclosure. They'll just sell their house, cash out to 250 grand and be done, you know? So,
right, right, right. Good point. Okay, Ryan asks, does the interest-only option cost an additional premium in rates above and beyond the regular DSCR loan?
yes, that's a great question. Yes, it does. To add the interest only feature generally is about a quarter to 0.3% higher of a rate than the fully amortized DSCR.
Okay. Christine's asking, when you speak of interest rates in the mid sixes, is that for investment loans or for primary homes?
For investment loans, you can get them today, right now, 25% down. I think as of a couple days ago when I quoted 6.5 was with like 2.25, 2.5 points. And a lot of the markets out there right now are covering a lot of those costs. So yeah, you're definitely getting the mid to high sixes today, right now, on an
So if you
investor
don't,
loan.
if someone wants to buy a property and pay no points, they're looking at just slightly below 7. Is that what we're at?
No, that's with points. The no points days have been gone for years and years and years.
Yeah,
Anyone
you
who's
have
bought a home
forgotten.
in the last 3 years, as we've increased to the point market, um, is aware of that, right? Anywhere you get a quote from a lender, you're going to be quoted 1.5 to 3 points for an investor loan. And I know when someone hasn't got a loan for a while and they call them like, "Thanks for the quote," and I know we're super aggressive, right? As the second largest lender, I know we're low, and they're like, "What's your no point rate?" And I'm like, "When was the last time you got a mortgage?" Because for 18 years we didn't pay points, right? Ever. There wasn't a need to, but it's
Yeah,
changed now.
right. Yeah, everyone's usually getting loaned with 2 points, normal.
Yep.
Um, okay, question is, I have a client that has missed a couple of payments. Can they still get a HELOC? I don't know, you probably need more information about that
Generally,
part.
no. They require you to have an impeccable payment history to get a HELOC. So if they missed payments on a home, then that's not an option typically.
Okay. Prem is asking, what if I have no primary home but only rentals? Will I still qualify for DSCR loan?
Yes, you will. There is an exception available for just someone like you, right, that already has a portfolio that can show they're an experienced investor. So yes, we definitely could offer you a DSCR loan.
Okay, great. That's good to know. Yeah, you pointed out on your slide that could be either primary or if you have experience with rentals. Here's a great question from Dale. I have 3 rentals with significant equity. Does it make sense at all to pull equity out of those to buy more rentals? And how? I don't have lots of liquid savings at the moment. This is a great question, Dale, because we get this as investment counselors. We get this asked all the time. Richard, what's your take on that?
It's a tough one, right? I like the numbers to do the talking for me. So there's a couple things you need to consider, right? Is firstly, you're going to access the equity from your house, either refinancing the first mortgage and getting a new first, so that involves increasing your rate, or by getting a high rate on an equity line, right? Now, the logic, of course, is hey, you're going to redeploy that money into a new real estate investment that hopefully is going to generate enough cash flow to cover itself, but then also still cover the line, right? The payment on the line or the loan that you took out from the existing rental. And that situation's very difficult and almost impossible. But also, it's not realistic. Also, if we ask ourselves, right, that you're gonna pull money, you're gonna have no money into it, right? You want to pull money from an asset increase the rate, and then use that money to invest in something else. And it's supposed to make sense as an investment, right? That's going to generate enough income to cover the loan you took. Once again, it's very hard to make those numbers work, but it definitely is possible, right? It takes finding the right properties, finding the right market, and putting together the right strategy. But at the end of the day, let's say one of your rentals, right? You had 50%, 60% equity, it's just sitting there. If you were able to spread that equity out between another 2 properties, right, without increasing your cash flow position, right? So let's say once everything's said and done, you're going to be same cash flow position, right? You're not going to make more money, but you're not going to make less. Would that be a good investment to you, right? The diversification of going from one asset to 3 assets now, right? And being spread across 3. For a lot of us, myself included, that would make sense, right? But even that would require you buying it, finding and allocating real estate investments that are going to generate enough cash flow, once again, to cover the loan that you took out to buy them, which can be tough. So I
Yeah.
think everyone's strategy will vary.
Yes. Yeah. Good answer. I'm kind of in the same boat with you. I think that if it makes sense, I mean, I don't think you should be in a negative position on the property if you pull money out to buy another property. But if you're working, and depending on how much longer you're working in your career, if you're 25 years away from retirement and you have a bunch of equity in your house, let's say you're making $300 cash flow in your house, so you pull money out, the rate's going to be higher today than what you probably have. But then your cash flow goes from $300 to $100, but you obtain another asset. To me, I think that's smart, because like we talked about earlier, it's not about just the cash flow; it's about the other benefits of leverage, and your total return on that new investment is going to be higher because you just leveraged a leveraged asset to buy another income producing asset. So in the
When you're
long run,
participating in the growth, exactly, of those other
yeah,
assets.
in the long run, it's going to be better. In the short run, not so much, because people say, well, if I'm going to pull money out, and I'm going to pay 7% of that money, and I'm only going to get a 5% cash return, then that doesn't make sense. But it does if you look at the big picture, like we just talked about earlier. Don't compare cash flow, monthly on a monthly basis. Look at the total benefit that you're going to get. So I think it can make sense if you're not having a hard time saving up more money to buy more rentals. At some point, that's how the rich get richer. They tap into the equity of their assets and they buy more assets with that. And that's
Exactly. But also don't feel trapped, right? Because as Aristotle just discussed it, as I said, it's going to be very difficult to find something that actually meets that criteria and generates enough income to cover the loan. So let's say you can't find one. So are you stuck and trapped with all that equity? No. Guess what? The beautiful thing of a 1031 exchange, don't be afraid to explore a 1031 exchange, because if you can take that one asset, sell it, not pay any taxes on the gains, and diversify that to three other assets, right? So it's not a question of taking out a loan and having to cover that payment. You're going to sell it. You're going to diversify into, let's call it 3 assets or 4 assets. That plan still exists out there, and a lot of people are afraid of 1031 exchanges. I know for a fact every real wealth counselor, especially yourself, you guys are very familiar with how they work and help people put those strategies together. So, don't feel, once again, if you can't save up more money to buy more and it doesn't make sense to access the capital you have, at least look at what a 1031 would generate in terms of return and see if it makes sense. Educate yourself
yes.
on it.
Yeah. Yeah, Joe commented here that 3 assets appreciating will outperform 1 asset appreciating. So it's a good point. So, okay, a few more questions before we end here. Rory's asking about DSCR loans. He says, does the loan application for DSCR require personal finance information like tax returns, et cetera? And does a high credit score have any benefit to lower the rates on DSCR?
Absolutely. So yes, a high credit score definitely has a benefit. They are credit score driven. The pricing is. As it relates to qualifications, you're not going to state any income on the application. You're not going to send in any tax returns. They are very credit heavy, so they will have you send mortgage statements on all the properties you own to verify that the most recent payments were made on time. So they'll verify credit, but they don't verify income at all.
Perfect. That's good to know, because I always have that question about DSCR loans. Okay, last question here. Does it have to be a 4-plex for the 5% down, or can it be a single family home to be divided into 4 units after the purchase? I think it has to be a 2 to 4 unit, right?
Well, I mean, a single family home, or the program, this change hasn't affected. A single family home, you could already buy with 3% down as an owner occupied home. Regarding splitting them, generally, once you take out a loan on a property, the lender doesn't want you altering the property and doing things like that. Of course, a lot of people still do it, hush hush. But that's not something a lender will officially condone, is you subdividing a property that they, collateralized as a loan.
Yeah, gotcha. Okay, great. Well, that's all the questions we have. Again, thank you, Richard. If you have any questions, anyone remain on the call, please feel free to email him, contact him, call him. His information is also on our website. But I appreciate everyone coming out. Thank you, and we'll see you again next week. Richard, thanks again for giving us this great information.
Thanks for the opportunity.
Okay, thanks, everyone.